All right, what I want to talk about today real quick is I just want to give kind of an overview of what's going on in corn and soybean markets, both from a supply and demand standpoint. Talk a little bit about some of the challenges that might emerge both on the export side in terms of competition with Brazil, and then kind of give some projections for old crop and new crop prices as we move through the remainder of 2019 and into 2020. First off, I'm going to talk just briefly about kind of what's going on in corn. You know, there's been some substantial challenges in terms of harvest pace. The weather up north has not cooperated with harvest up there, so we do have some challenges there. But in terms of what we've been seeing as we move into 2019, seeing some challenges on the export side. So again, this chart here, what it depicts is it kind of depicts consumption in blue, exports in green, and then production in red. And then our ending stocks number are these triangles at the bottom. A couple of trends that we obviously want to end up discussing here. The first one is when we look at U.S. stocks of corn, they have been decreasing since 2016, although they still remain reasonably close to record highs. So right there, we realize that we're going to be carrying in some additional corn into the 2020 marketing year, which is going to end up limit some of the ability to end up having increased prices without a substantial production disruption someplace else. Consumption domestically has been pretty consistent, highlighted by the blue bars here, where you look at ethanol and then feed use primarily as the two sources of consumption. Ethanol, there are some concerns there. You know, there's some policy issues that need to be ironed out in terms of what President Trump and his administration is looking to end up doing. But what I would anticipate in terms of ethanol or demand for corn for ethanol, I think we'll move mostly sideways, keep right where we've been in that 5.2 million bushel range. I don't anticipate major changes there. Exports is kind of a wild card. I did kind of want to highlight the reduction in what we've seen in exports. This is combined with a couple of different things. It's not just necessarily China, but there is an impact in there. China's not a huge importer of corn. It kind of picks its spots in terms of when it's importing corn or distillers grains. But you can see in 2017, the U.S. exported 2.44 billion. In 2019, 1.85. So again, we've seen a reduction. A lot of that coincides with a little bit of a drop in what we've seen in terms of production. This is the one that's kind of a little bit more concerning in terms of trends, and I'll talk a little bit about soybeans in this regard as well. But the share of global corn exports that the U.S. represents has been decreasing over time. This isn't something that's necessarily specific to the trade disruptions that we've seen. But we, back in 2007, had a high of 63% of the export market. Now, 2012 is obviously a production-driven anomaly. When you look at this line, obviously we had the dramatic drought that affected a big chunk of the production area, which ended up reducing the amount that we exported. Exports for corn used as a balance when we're looking at you know, production consumption. We export kind of what we have in terms of surplus. Now, it's not 100% accurate, but it's just kind of a basic principle where if you have surplus, you're going to end up putting it on the global market. Well, when you have a production fall off like 2012, we ended up seeing a pretty dramatic reduction in the share of corn that was coming from the U.S. Where we're at right now is projected to be at about 28% of the global share, which, as you can see, we've kind of bounced around ever since 2013. But again, what we've seen is 2018, 2019. Now, that can be attributed partially to some of the trade disruptions. Obviously, China's the one that gets the most amount of press. It would be nice to end up seeing some finalization of the USMCA, the trade agreement with Canada and Mexico, be finalized. I think that would be more beneficial to corn and distiller grains as opposed to soybeans. Look at world corn production. This does provide some positive news, I guess I should say. And again, we don't want to get too much into the weeds in terms of the exact numbers. What we're looking for here is more kind of broad trends. What can we expect in terms of production, consumption, and stocks as we move into 2020? Well, the most important numbers on this graph are that bottom gray bars, the ending stocks number. And you can see we've peaked in 2016 at over 13.86 billion bushels of corn reserves globally, but we've went down, and we've actually went down reasonably quickly the past 2 years. If you look at between 2016 and 2018, about a billion bushel reduction, 2018, 2019, another billion bushel reduction. So when we're starting to see that trend down, that should be supportive for global prices. Now, again, with some of the trade issues that are going on, it might be difficult given that there's still substantial reserves relative to the 2006 to 2012 time period, but there is some opportunity to maybe end up expanding or replenishing some of those reserves as they come down. I do want to talk quickly about Brazil. I mentioned this in the in-service training this last week, but I do want to kind of highlight some of the numbers that are coming out of Brazil. It is a really dynamic agricultural production region, and it's going through some pretty rapid changes. So one of the ones I just want to kind of move around this panel. I know it's pretty busy, but I wanted to get kind of everything on one slide to kind of highlight what is going on down there. The first thing that's really important to notice is that there's two different crops. There's a first crop and a second crop for corn. So the first crop is planted August into October, and then it's harvested February through March. The second crop is the one that's planted behind soybeans. And so it's planted in January and March, and then it's harvested in May and August. And so when you look at over time, this top up figure number 1 here, you can see that the planted acres, yes, it's went up, but not substantially. What we've ended up seeing is actually a reallocation where that first crop, so the one that's planted in our fall, end of summer, early fall, has been going down. And what's been rising has been the second crop. And that is the one that's a double crop. So they're getting two crops from the same acre there. And what you've ended up seeing is an increase in production over time. And again, that's been driven by kind of two things: moderate increases in acreage and then improved yields. And so when you see where a lot of Brazil's production is coming from, it is now coming more from the second crop than it is from the first crop. And that has some ramifications for global exports, because all of a sudden, when that second crop hits in our summer, it is competing with some of our export business before we end up getting into the fields and really get going harvesting. So yeah, that can be a challenge. Now, Brazil is not as big of an exporter of corn as they are of soybeans, but again, it is an important change over time in terms of when production is available from South America. The other one that I wanted to highlight, and this is one that is important, we've seen kind of a convergence between the two different yields. So the first crop yield and the second crop yield. First thing that most people will notice is there's substantially lower yields than where we would have in the US, where even in 2018, 2019, somewhere in that 80, 90 bushels. So again, quite a bit lower. A lot of that is due to some of their production challenges in terms of procuring inputs. Most of their corn is not irrigated, and if you're doing a second crop, you're going to naturally have a bit of a lower yield. Now, that's not to say that they're not working to overcome those, and they are increasing that yield substantially. So if you look at 2000, or roughly 2000, up to 2019, what we've seen is an increase of about 50 bushels per acre to 90. So again, they're still well behind us in terms of yield, but they're starting to catch up. And I expect that to continue as we move further out in time, as more varieties that are specific to the growing conditions down there are incorporated into their agricultural systems, and then also having more efficient use of inputs. Irrigation is not something that they currently do, but that does provide maybe some potential long-term to further increase the production. So again, the point I want to make on this is this competition is not going away. If anything, it's going to intensify for both corn and soybeans. But again, this is something that is rapidly changing over time and will continue to provide stiff competition in terms of U.S. exports. So when we look at what the price ramifications are on this, what I've done is I've kind of broken this into two different time intervals. So when we look at Brazilian prices, this is at one of the ports in Brazil. You'll notice the dotted line is from 2000 to 2010, and the solid line is 2011 to 2018. So again, looking back at this chart right here, I kind of selected that time period where we really started to see the rise of the second crop. So first thing that you'll end up seeing here is what we've seen is where we typically would have that first crop harvest. We've actually started seeing a price premium down there, whereas, you know, 10 or I guess 20 years ago now, 10 to 20 years ago, that was kind of their seasonal low point. Now what we've seen with the second crop is we've seen a low rather than a high. So again, it's changing some of the stuff that is being seen by Brazilian farmers down there in terms of price expectations as it moves through the year. So with that being said, I want to kind of talk quickly about kind of our old crop, or the crop that we just finished harvesting, or most of it's harvested, I should say, in Tennessee. I'm sure there's some that's still out there. But I kind of want to look at where our pricing opportunities were before we start talking about some of the marketing that we might end up being able to have some opportunities moving forward. What we ended up seeing was back when we had all those prevented planting issues, the extreme flooding, both along the Mississippi and through the Mid-South, but primarily up in that Ohio and northeastern Corn Belt is where it was really bad. The Dakotas had some substantial flooding as well. We had some really good opportunities in terms of pricing corn up around that $4.60, well above $4. When you look at opportunities above $4, all these boxes represent the time periods. So we had kind of that early spring time period where there was an opportunity to get just above $4. Then we had that production, or that anticipated production disruption, where we got much higher prices. And then again, we had a little bit in the fall here. So again, when we think about this, you know, we want to end up thinking about, okay, well, this one right here is obviously a weather-driven anomaly where you're looking at having prices. Yes, we want to be able to take advantage of price spikes when they occur. But again, from a risk management standpoint, what we really want to try to do is highlight some of these ones where it's not maybe as unpredictable as a in-season price disruption. So when we look at where we are in terms of basis right now in 2019 relative to the 5-year average, and again, basis is that nearby futures, the cash price minus nearby futures. What you can see is we really had a deeper basis in general across Tennessee than what we typically would. Our average back in September was 23 under. A lot of that was due, we had increased acreage in Tennessee. We almost had 1 million acres harvested of corn, which was up about 200,000 from the past few years. So again, what we ended up seeing was pretty good yields in Tennessee, higher acreage. So we did see that deeper harvest basis. Again, these are relative to elevators and barge points. So for those that are looking at the poultry industry or other feed companies that are selling corn direct, you can adjust kind of based on what local conditions are. But what we've really seen is we've seen this increase back up to where currently in November, we're about 3 over on average. And a lot of this is being driven with some of the uncertainty, particularly out of the Eastern Corn Belt. So again, I mentioned Ohio and Illinois, where they ended up having substantial prevented planted acres. There's a much stronger basis in the Eastern Corn Belt than the Western Corn Belt. So again, we are getting some of the influence there. So when we look at kind of our old crop, or the crop that we just finished harvesting, there's still a lot of uncertainty, particularly for this time of year. Normally this time of year, we've kind of went through where we are in terms of national yield and how much harvested acreage there's been. But given some of the cold, wet conditions, particularly up in the northern states, there's still, the USDA's crop progress report estimates that there's about 66% harvested compared to an average of 85%, so almost 20% behind. You know, there's obviously some error in those numbers, and there will be additional harvest. But the big question is, how does that affect our national yield in terms of what are we expecting in terms of the production impact? To get more specific kind of to Tennessee, one of the big advantages that we have is this predictability of basis in corn. And so again, utilizing storage to take advantage of those basis opportunities, I think is one of the most powerful tools that you can have. Avoiding selling off that combine and then picking your spots once you've ended up getting the product in the bin. Obviously, there's still some risk once it's harvested, but you've removed a big chunk of that production risk. So one of the other ones that's always important is to look and actively seek out those market opportunities. We have poultry, obviously, is the main user, but we have other feed providers. Distillers can be, small loads, depending on the size of the distillery. But again, there are other sources out there that I think can be advantageous. And even if you're getting a 20 or 30 cent premium on a small load, so 1,000 bushels, it can be advantageous to take that in and increase your average selling price. Now, one of the important things when you're storing corn is to obviously look at what the storage costs and risks are. So again, even if we already have the bins and infrastructure, there is a cost and there are risks of spoilage. There's some additional labor costs, potentially additional trucking costs. So we want to make sure that those are evaluated so we can end up making sure that we are getting a net higher selling price after we factored in those added handling, storage, and transportation costs. In terms of old crop corn outlook, again, this is kind of more speaking to elevator and barge point prices, so adjust for poultry and those types of things that can be on-demand contracts. But what I think we're going to see is kind of 2019, early 2020, we'll see cash prices move. 375 to 435 is kind of a reasonable range. There's always the opportunity to end up having a shock that moves us outside of there. The one that obviously right now we'll be paying close attention to is how that harvest wraps up in some of the northern states. When we switch to new crop, so when we start looking at the 2020 crop, one thing that kind of jumps out here is that we've seen pretty consistent trading range in the December 2020 contract. And so I've highlighted kind of three different levels here. 394 is the low that we ended up having so far. That was back in early September. And then we had 423 as the high. And again, that was driven partially by some of those prevented planting issues. But we've been pretty consistent. What we've looked at there is, roughly about a 30-cent trading range on the December contract. 408 is pretty much right in the middle between there. I think that's a reasonable place to start looking at doing some sales. Pushing outside of this range as we move through early 2020, I don't think is going to be overly likely unless we see some type of production disruption down in South America. In terms of seasonally, what we end up seeing in terms of the December corn futures contract. So again, what we typically end up seeing is this red line right here is the 5-year average, where back in December, so this would be December of before the crop. So for 2020, this would be December 2019. You're always looking, further back. But we typically get an opportunity to end up pricing kind of in that March, April, May. 417 was kind of the average high over the last five years. So again, factor that into pricing decisions. Does it always hold? No. This blue line shows the 2019 contract where we peaked at 450. But again, what we really want to avoid are these prices right here, particularly on the futures and cash prices. So again, pricing some, I'm not saying it's time to get aggressive in selling the 2020 crop, but start considering or identifying some of these targets in terms of what you're anticipating both from a future standpoint and from a basis standpoint. It was also brought up last week when we got together, and I think Andrew made this point, but there's no reason why you have to do both futures and basis at the same time. If you do those, if you secure those on production, that's basically a cash forward contract, right? I mean, you can do them, but you don't necessarily have to. So if you think that there's a beneficial futures offering, you can lock in that futures price either through selling a futures contract or an hedge to arrive contract, or you can end up just securing the basis. If you get a basis offering that is attractive, you can end up locking that in and let the futures float. So again, using some of these marketing tools, I think is a really important risk management tool, particularly given some of the uncertainty. And we'll talk about kind of what we're seeing in terms of 2020 planting. that might provide some headwinds for corn. So when we look at new crop corn pricing, we're over $4 right now on the futures. I really like starting pricing somewhere between $4 and $4.20 on the December futures for the 2020 crop. Evaluate all those tools, and I'm a big proponent of pricing in increments. You know, doing all or nothing, I think opens up a whole bunch of risk. If you can kind of spread out those pricing decisions over time, I think it's usually pretty beneficial. U.S. plantings could increase for 2020 due to relative prices. I'll kind of show where we're at the end in terms of relative prices between corn, soybeans, and wheat and cotton. We might see some reduction in that second crop Brazilian corn crop. And part of that is they were a little late getting soybeans in. So again, there could be kind of two different impacts there. You could see a potential reduction in second crop planted acres, and you could end up seeing, given a late planting, maybe a bit of a yield reduction. Now, a lot of that is to be determined later, but that's something to keep an eye on. So in terms of looking at 2019, 2020, early in 2020, Tennessee cash prices, looking somewhere usually probably around that $3.95 to $4.25 in terms of prices. Switch it up to soybeans. You look at soybeans, obviously we had a dramatic impact due to the prevented planting, where we ended up seeing U.S. production dropping down to about 3.5 billion bushels is what it's currently estimated at. That was beneficial in terms of reducing those stocks back in 2018, largely due to the trade disruption with China. We had stocks approaching 1 billion bushels, which is incredibly high relative to where we've been. We're estimating to have some of those stocks eaten in, primarily driven by production. We are anticipating a small increase in exports relative to last year. A lot of that will have a high degree of uncertainty and depend on how trade negotiations progress with China. The phase 1 deal that has been around the ag news recently should end up, if implemented and signed, should end up increasing ag exports, and I would suspect that soybeans would be a principal beneficiary of that. I do want to highlight Brazil again for soybean production, consumption, exports, and ending stocks. So again, when you look at where Brazil is and where their trajectory is going, they're still increasing production and they've become the dominant exporter. When you look at export share, this is export share primarily, again, driven by China since they are the largest purchaser of soybeans. The one thing that you will notice is this transition from U.S. being the dominant soybean provider to Brazil being the dominant soybean provider occurred before the trade disruption. The trade disruption has amplified it, but you can make a strong argument that this was something that's been in the works before we ended up seeing this trade disruption with China. Back in 2008, U.S. was responsible for 45%, Brazil 31% as a low in 2009. Now Brazil's at over 51%. We're down around 32%. There's a huge amount of uncertainty as to how much of this market or the Chinese market that we will be able to recapture long term. There's a couple of things that work against us. Obviously, one is this continued upward trajectory in Brazilian production. The second one that I find a little bit more difficult to quantify, but the conceptualization is there. When you look at Chinese companies investing in infrastructure in Brazil, both ports and inland transportation systems, they're going to want a return on their investment. Now, it's challenging to get hard numbers as to what the amount of money that has been put in there, but there is no arguing that there is some investment coming in from state-owned agencies in China into Brazilian agriculture. And if you think intuitively, they're going to want some return on that investment. We ended up talking about this a little bit, but we had that price gap, and what we've ended up seeing is that's closed down. When the retaliatory tariffs were initially put on, we ended up seeing Brazilian prices substantially higher than U.S. What we've seen is convergence of those prices. How these end up reacting moving forward is going to be dictated largely by what's going on in terms of China-U.S. trade agreements. World soybean production, consumption, and ending stocks. Again, what we've seen is kind of counter to corn. where we've had this rise in stocks globally, which again is going to provide some headwinds. We've seen a bit of a step back. This is largely due to the drop that we showed in previous slides for U.S. production. But again, that's something where we'll probably see a little bit higher prices in 2019-20 than what we've seen in 2018-19. You look at nearby, this is the January futures contract. Again, what we've seen is a pretty wide trading range, 960 all the way down to back when we were at about 920 as a low. One thing that I think has helped, and again, this speaks more towards that reduction in U.S. acreage, is we've kind of been setting this bottom trend line in terms of where prices are hitting a floor. And so to me, that's kind of a positive development. We still have a pretty hard cap in terms of what we're expecting in terms of cash prices up in that 960 range. But again, as we extend this out, there's reasonable support down here in terms of prices. And a lot of that is, again, we do have Brazil providing China a whole bunch more soybeans. But when we look at other countries, if we're relatively cheaper, they are purchasing more U.S. soybeans than what they have in the past. When we look at basis, again, what we see is we see that typical harvest nature where we have very low or very weak basis numbers during our harvest. The Brazilian harvest is here. And so again, since we are more subject to exports, particularly in Tennessee, for soybeans than corn, we typically have a much weaker basis. And we expect that to continue. If we do get large export sales, we could end up seeing some strengthening of basis as we move into the new year. When we look at old crop soybeans, we still have quite a bit of uncertainty up in those northern states, about 85% harvest, so not quite as far behind as corn compared to an average of 92%. We're still going to run into headwinds from South America. Their growing season is well underway now. So again, we'll have to end up seeing how their crop progress or crop conditions continue to emerge as we move into 2020. The China trade deal, the phase one, maybe, maybe not. Depends on which article you read and what day you're following it, but it can be challenging. We would expect reduced 2019 soybean production in the U.S., and then again a cash price of $880 to $960. When you look at new crop soybean futures, again, what we see is that pricing opportunity, and on average, is typically higher in that March, April, June. What we want to avoid again is that harvest interval. Look at 2020 soybean futures. Got a pretty hard cap at 985. We're well above the lows. I don't think we'll retest any of those. What we're looking at right now is kind of a target of about 970. So global stocks are still high. There's still a huge amount of trade uncertainty out there. This one here I think is really important. How many acres are going to be planted in 2020? Are we going to end up continuing to see government payments on that? We'll have to wait and see. African swine fever, I think, is something where we could end up seeing a pullback on demand, which would obviously be negative for prices. But the degree of that is largely unknown at this time period. And that's not just in China, that goes through a bunch of different South American countries. So in terms of 2020 cash prices, we're looking in that 920 to 990 range. I just want to close with kind of some of the price ratios that we're currently seeing. And so this chart looks incredibly busy, but the main takeaway I want people to have is that all three current prices for 2020 favors corn. So again, what you have is you have the average price ratio here for soybeans divided by corn. The average is 255. We're currently at 220. So again, favors corn. Similar with wheat. Not so much a big issue in Tennessee, but when you go into the northern plains, that is an issue. Average of 145, currently at 112. So again, favors corn in terms of planting. Cotton, when you look at 0.18 versus 0.16, again, favors corn. So again, all three price ratios favor corn. If that holds, what we'd expect to see is increased corn acreage. So again, when we consider that into kind of our what we want to do in terms of a marketing plan, we would want to end up closely monitoring these to end up seeing, well, are we going to see a dramatic increase in corn acres? we keep the ratios where they're at, we'll definitely be up. How far up, we'll have to wait and see. The other thing that obviously factors into that equation, and these slides will be posted because I'm running a little long right now. But again, what we want to be cognizant of what our costs are relative to where they have been and what cost items are changing. This is for corn. When you look at seed, obviously a much bigger percentage than in the past in terms of total cost. So again, we have an average here of 2016, 2018 of $574 an acre compared to $351 an acre back 10 years ago. Soybeans, you get a similar cost structure in terms of how things have moved, but we really want to end up looking at where we can save money and what these costs are relative to what our expected revenues are. So again, looking at these different cost items will affect the planting decisions as we move into 2020.